Welcome to this week's edition of Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as gold, copper and uranium in a separate video. I'll leave a link for that in the description section below. I'm also going to show you a key market that is just breaking a big level, so make sure you stick around for that. As always, this is general commentary, doesn't take your personal situation into account. With all of that said, let's get into our first chart. So we've got the S&P 500 up on the screen. And this really has been a hugely important week. The integrity of this whole rise from the October low last year, it's really being tested for the first time in many months. And had a situation through the week where the S&P 500 has come down to the lower boundary of this trend channel, and we initially saw a bounce late last week, early into the current week, and then in the last few days, we've seen the price action start to give away again and retest and actually edge through to the downside of the channel. Now, just below there, we've got a key support, and I think this is probably the most important feature on this chart is this support here at 4,200. You can see it's been a technically active and important region stretching back to March 2022. On the lower half of this chart, it was a key resistance region, and now as we're coming back down and reapproaching it, it switches to support. So we're going to see just how much support it's about to provide. I don't think that the way things currently stand, I don't think this is currently setting up for a major decline, for a sharp decline, at least in the near term. I think there's certainly a vulnerability while the S&P 500 is below these moving averages. So we have the 50 and 100-day moving averages. So whilst below there, yes, there is vulnerability, but I think we've got to keep in mind 4,200 is a big level. I don't think it's just going to fold in an instant without giving some sort of underpinning to the market. I think there's actually a strong likelihood that it does initially hold and provide some sort of a rebound, which we'll talk about a little bit more in a moment. Another thing to keep an eye on is I'm going to switch this over to a weekly chart. So when we do this, the moving averages become weekly moving averages. So I have a 50 and a 100 week moving average. And you can see the 50 week moving average is coming right up where price action currently is. 100 week is just beneath that 4,200 support region. So they act like active support levels. They're moving, of course, because they're moving averages. So they're moving, but unlike a static support, they're an active support. So often the market will come back to these moving averages and test and rebound. And you can just see multiple times over the years where that's happened. So it's just a layer. It doesn't mean it's going to work this time when the market is going to rebound, but they're areas to be aware of and to respect the ability for the market to rebound off them. Now, I want to show you something else which I think is really interesting, which I've been keeping a close eye on. So let me explain what I've got here. This is a weekly. It's a weekly chart. The top chart, the orange line, is the S&P 500. The indicator beneath it is the number of stocks, the number of S&P 500 stocks above their 50-day moving average. So you've seen this indicator a few times over the previous months. Occasionally I bring it out when it has something interesting to discuss. And it's certainly got something interesting to discuss today. So what we can see here in current time is the number of stocks above their 50-day moving averages. It's come down to about 6. It's only around 6% of stocks are above their 50-day moving average, which is extraordinarily low. So when we just compress this back up again, you can see that going back to where I've got data back to 2007, it's only come down. It's only been this low on say 9 previous occasions. The blue line above is where we more typically see the indicator pull back to. That's around the 20% mark. But at the moment, we're way below that. We're down at 6%. Now, have a look at what's happened on the previous occasions. It's the indicator's been this low. And now the point I want to make here is that this doesn't necessarily signal that a major low is in place and the market's going to turn around and start rallying. But what you'll see is now these blue lines, what I've done, I've marked the start of the blue line from the point where the indicator touches this lower level at 6%, thereabouts, about 6%. This is the point where it touches, which is where we currently are. And when that happens, you'll notice that the market typically doesn't go into a tailspin. It's not the start of a large full-on sell-off. It's not the start of a crash. More often than not, it's either in this case, back in 2008, it was a pause, it was a slight bounce, it was sideways before another decline. And this one here became a low point. On previous occasions, you can just go through on your own and look at them. They're typically not the start of a crash. It's getting closer to the end of a decline. COVID was different. It was not even quite the midpoint. The market had a lot further to fall, but I don't think the current situation is COVID. So I'd be looking at this as more of an extreme event. Other occasions, it's more getting close to a low point. So that's something really interesting, I think really important to bear in mind with where the market currently is. It doesn't mean it has to rebound or it can't go lower, but it tends not to be the start of something big. Now, having had a look at that, I want to go back to, let's just go back to this daily chart of the SP 500. So with all that in mind, what I've just gone through, this is what I think could happen here. I think we could get some sort of a bounce that develops off this support, just to relieve, at least the minimum, to relieve an oversold situation which is currently present in the market. If that were to happen, and there's no guarantee that will happen, for all I know is the market does crack beneath this support and fall heavily. It's always a possibility. But should we get a bounce, what I want to see then, I'd want to watch it carefully, watch it and analyze what the bounce looks like. What sort of bounce could we get? A shallow bounce that can't retake the moving averages would be a concern, because then that would provide a platform for the market then to dive from and head lower. So shallow bounces are concerning. Strong bounce, that would be more interesting. What we can also do, we can put on some Fibonacci's from the most recent decline, and you can see like a typical Fibonacci bounce could see the market back up towards 4,400. Look, maybe not even that high, maybe just in the low 4,300s even. Would still be a meaningful bounce, but somewhere within this Fibonacci range is possible, takes it back up towards the moving averages. Then we assess it, we analyze it, and we go, okay, what are our possibilities from here? Is it setting up for then maybe pausing and rallying again, or is it stalling and then likely to go down and retest and maybe break this 4,200? But I don't think we're quite there yet. If we get that consolidation below the averages, or those bearish scenarios and possibilities come into play. And as I was saying last week, I think it's a case of that. Well, this is what I'm doing. I'm selling stocks that are breaking their support and hitting their stop losses, and I'm just not in a hurry to buy this dip. Even if we get a bounce, it's not a dip I want to buy. I want to see how the bounce looks. If we get it, then we consider, okay, what do we do then? Because look, I am aware, and I think we have to be aware that whilst we are below moving averages, which are starting to roll over, starting to decline, it's a point of vulnerability, and it is always possible that 4,200 breaks and this becomes something bigger. And I did talk about one possible scenario, I think it was 2 or 3 weeks ago, which could see the market fall significantly. But let's not get there at the moment. That's not the play just yet. Let's see how the price action unfolds. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Just tells YouTube you're watching, and YouTube shows other people, and that helps me heaps. So, yeah, please do that. Now, let's get over to the Russell 2000, the small caps. Disappointing week. More selling, and quite a steep sell-off at that. We're now retesting this low from back around April, May, and we had a clue this was a possibility a few weeks ago when we started to get below this support at around 1,800. Got a fairly shallow or muted bounce back up towards that old support, which became resistance, and the sell-off has ensued. Below those moving averages, breaking support is always going to be that vulnerability, and we've seen that play out over the last week. Now, I think that the thing here is that I've been saying that I thought there was a possibility that this could become a large basing pattern. I've been saying that for months, and that it's still within the realms of possibility, but we've got to play the hand as it's developing. And at the moment, we're at the lower end of the range. We're below those averages, so that may not play out. It is a possibility this market does at some point break to the downside of the range. Hasn't happened yet, but I think caution is very much required as we watch how this plays out. We can draw in some support. There's some support coming in, just some near-term support coming in just around 1,710-ish. Maybe that coincide with a bounce in the SP 500, perhaps. Let's just wait and see what happens with that. At any rate, I'm in no hurry to buy this dip. I want to see positive price action. I want to see upward price action, gain traction, start to get above resistance, start getting above moving averages. Then I start becoming interested again. Could this be a base? Well, it could still be, but we also need to be aware that it could be a continuation pattern that ultimately sees the market goes lower. So I think it's a case of not having strong convictions either way, but playing the price action as it comes. And sometimes the best play is simply to sit and wait. And I think this is one of those times. And I think the ability to wait for the right opportunities, to wait for the market to show its hand, I think it's just one of those big factors in success. So we'll keep an eye on this. Let's see how it plays out this week. And jumping over quickly, US dollar. This rising US dollar is putting pressure on many assets. We got the false break to the downside back in July, and ever since then, it's been a relentless rally upwards. Just broken above resistance. You can see this resistance band here, which stretches back to May 2022. And we've got the rising moving averages. I spoke about the breakout of this trading range, might have been a month or two ago. And it's just continued clearing the resistance and now up at the highest level it's been since almost a year. So this is something which is, I think, putting pressure on various markets. You can see the break we've just had, the break higher coincides with a breakdown in many of the commodities over the last week. We've had gold, silver, copper all weakening, oil weakening. As I say, I think it's a case of playing this conservatively, and really a case of just keeping that powder dry until we get some clear signs of where the supports are holding, where the supports are breaking, and continue to control that risk, know where you're getting out of stocks, and being very selective about the stocks that you get into. Well, okay, let's leave it there for this week. Thank you for joining me. Hopefully that's been helpful. I look forward to coming back and talking to you next week. Till then, bye for now.